As Trump comes to reconsider the sort of energy transition, environmental policies, this is a first step in granting waivers, right?
Yes.
But it's not the only step in terms of the renewable fuel standard, right? Because there's more to come. Hello and welcome to our lucky 13th episode of Oil Insights Trading Trump. I'm your host, Harry Tchilinguirian, Group Head of Research at Onyx Capital, and I'm joined here today by Onyx Research Associates Vincent Wu, Martha Dowding, and Mita Chaturvedi. Before we start the show, as always, please like and subscribe to the podcast. I also invite you to visit Onyx's LinkedIn and YouTube channels for more interesting and exciting content. Now, the dust is beginning to settle following the election of Donald Trump as the 47th President of the United States. Front-month Brent has fallen from an intraday high of $76.24 on the day of the election to roughly $73 at the time of this podcast. The format of today's episode is going to be a little bit different as we focus on price direction in the wake of Trump's victory. We'll be exploring how we could translate the implication of Donald Trump's policy proposals, both domestic and international, into actionable trade ideas. So we went into some details on the implication of Trump's presidency in episode 11 of Oil Insights. So I invite you to watch that again for the deeper dive. We have three trades in mind, one for Brent, one for U.S. gasoline, and finally one for Asian naphtha. Now, at their core, Mr. Trump's economic proposals are not very different from those he put forward in his first term as president, namely reducing taxes, raising tariffs, and implementing lighter regulation. President Trump will most likely extend the 2017 tax cuts of his first administration. However, the scope for additional tax reductions may be a little bit more limited in our view, and in turn, the boost to the economy may be less pronounced than what some may expect. In contrast, the scope for imposing higher and broader-based tariffs is much greater. Trump proposes a tariff of 60% on China and 10 to 20% potentially on everybody else. Now, this would raise U.S. tariffs probably back to the level they were in the 1930s. Yet, how much of the touted tariffs during the campaign amount to posturing ahead of trade negotiations? It's hard to tell, and how much is actually going to be imposed still remains to be determined. And that, of course, also remains to be determined, retaliatory measures of those who are affected by these tariffs. So in episode 11 of our Oil Insights, we highlighted the IMF's warning about the economic fallouts of trade wars. Even if only directed at China, tariffs could have spillover effects on other countries. The proposed tariffs, stoking inflation fears combined with a projected increase in U.S. debt, give you a recipe for higher yields and a stronger dollar. The strong dollar is expected to adversely impact dollar-denominated commodities, of course, including oil, but more importantly, emerging market economies. These economies account for the bulk of oil demand growth. So if they take a hit, then oil demand will probably be weaker if President Trump goes down that aggressive tariff route. The manufacturing sector in particular in these countries, notably that of China, would be first to be affected. The oil products that would be impacted first would be diesel for trucks, fuel oil for shipping, and naphtha as a feedstock to the petrochemical industry. Now, non-OPEC supply growth is, for lack of a better word, committed. So if demand is weaker and non-OPEC supply growth holds up, well, we have a higher implied global oil surplus in the balance next year, and that essentially suggests to us that oil prices can weaken. Now, regarding regulatory constraints or policies related to energy transition under the Biden administration, we could expect these to be dialed back. Now, deregulation could help alleviate supply constraints in the upstream or the downstream sector through faster permitting, approvals, and waivers. New infrastructure like pipelines could be developed and deployed more quickly, both upstream and midstream. Perhaps more importantly, greater access to drilling on public lands or offshore would be granted, fostering more supply growth in shale and conventional oil production. Far from us to suggest that the U.S. shale oil industry will return to drill, baby, drill, but as the industry has transformed itself, focusing on capital discipline and profitability, now compared to the first time that Donald Trump was around in the office, it's going to be a little bit different. Downstream, the renewable fuel standard could be changed, reducing a refiner's renewable volume obligation, or the volume of renewable fuels as a percentage of total fuels that it has to commit to. In this case, refiners who could not meet previous volumes would no longer need to buy the same number of RINs from other parties to be compliant. So we're looking at domestic diesel supply and perhaps more importantly, gasoline supply in the US as being far more available in terms of production. Now, this would eventually put downward pressure on retail prices, a stated objective of Mr. Trump. So dialing back measures related to the energy transition, including the Inflation Reduction Act tax credit for EVs, or even the EPA's tailpipe emission regulations, could positively impact gasoline demand in the short term. However, this support needs to be set against any negative feedback from retaliatory tariffs on the US economy through higher import costs, albeit timing-wise, this is a longer-term consideration. Then there is foreign policy, as we often talked about during the campaign. Candidate Trump did not formulate anything specific in terms of policy, but we examined those policy implications in episode 11 concerning Russia, Saudi Arabia, and Israel. These are expected to change significantly with a chance of potentially unlocking more supply and or reducing geopolitical risk premia in oil prices. Even some diffusion of tensions in the Middle East would help to put downward pressure on the prompt flat price. While we've argued in episode 11 that the US would apply maximum pressure on Iran, potentially leading to a loss of 1 million barrels a day of crude exports, we now also consider a more nuanced view. A looser oil balance would certainly favor lower oil prices, which is in the US economic interest. Thus, the pressure applied to Iran may not necessarily replicate exactly what we saw in 2019 and 2020. The cabinet appointments may reveal how much Donald Trump wishes to apply pressure. If Iran hawks like Mike Pompeo or Nikki Haley are not part of the next administration, well, maybe Trump is trying to thread a different needle. However, Trump could easily appoint another Iran hawk. So we don't really know, and we'll have to wait and see. Now, that's a lot of introductory talk. I think the more interesting thing is the trade ideas our research associates have developed, so we're going to be turning to those. And I'm going to start off with you, Vincent, on the crude side. What are we looking at? After everything that has been said and done around Trump, how would you crystallize all of that in terms of expressing that in a trade idea? What are you thinking?
Yeah, so the trades we propose on crude oil reflects a supply side angle. For our viewers that do agree with our view, we favor shorting crude. So we've got two trades. As a first trade, we recommend shorting the June 25 WTI versus Brent spread as a reflection of ongoing growth in US crude production, which the Trump administration would favor, and more importantly, exports. So that would pressure WTI in relation to Brent, given the from a supply side angle, more production, more exports. Alternatively, in the same line, we can recommend shorting the Q2 25 Brent versus Dubai spread to reflect the greater availability of light sweet crude in the Atlantic basin. And more so, this trade also assumes that OPEC Plus may continue to restrain its output into the second half next year, 2025, in view of weak global balances.
So if we delve a little bit more into the details of your thinking. So two trades, one, the transatlantic ARB, downward pressure on TI relative to Brent, domestic considerations. And then we have this broader, more global trade, another ARB trade, Brent Dubai. So what's driving both?
Cool. So the overall thinking driving these trades is as follows. So we do expect the US to produce and export more crude oil. So assuming Donald Trump will continue pursuing American First Energy Dominance agenda as outlined in his September 2018 speech at the UN General Assembly. So in our view, US crude exports, which regularly surpass 4 million barrels per day per EIA stats, may inch closer to 5 million barrels per day in 2025. In addition, so current crude oil exports from US Gulf Coast to Europe is averaging about 1.9, close to 2 million barrels per day according to tanker tracking data. And exports could, if there's an increase, should surpass regularly above 2 million barrels per day in 2025. So meaning that more WTI Midland crudes will land in Europe, and with the region's oil product demand and by extension refinery crude demand growth in 2025 expecting by the IEA to be quite modest. So with US crude a very important part of the data Brent crude assessments, more US crude will definitely weigh on the data Brent benchmark and on the prompt portion, which would pressure data Brent physical differentials. So in turn, this would generate greater convergence, the narrowing between WTI Brent, and at the same time pressure Brent Dubai because of the Brent components. In addition, so onto the Middle East part, if Trump were to enjoy some diplomatic success in the Middle East, then the structural components of geopolitical risk in a flat price would deflate even further. But this should affect Brent and Dubai equally in terms of flat price, I suppose. And we don't know yet what Trump's policies will be regarding Iran, but in my opinion, the US, should they apply maximum pressure, this would keep medium to heavy sour crude grades like Dubai relatively supported, and hence that would be more bullish for Dubai and short, which would favour our short Brent Dubai trades. So finally, OPEC would likely roll over their voluntary cuts into next year, but that policy cannot last forever. So we could see some of those barrels coming back into 2025, but that would probably come in the later part of the year. So I'm taking the view that this, should that happen in the second half of 2025, then it would be favourable to short Brent Dubai in the Q2 portion.
I see. So it's very interesting. So your take on Trump from a crude perspective is really looking at ARBs. And I think we have an interesting dynamic between the TI Brent that needs to widen since we're shorting the spread, whereby there's going to be more exports and we may need to have TI discounted a little bit more in order to push those exports over to Europe. And of course, since Midland crude is landing in Europe and that is an integral part of the Brent complex, we're going to have downward pressure on Brent. So then you have this knock-on effect of Brent versus Dubai, where Dubai remains supported both in terms of OPEC still holding the line on maintaining its voluntary production reductions, and of course a possibility, as you highlighted, for Trump continuing, and I think it's fairly widely shared possibility for Trump maintaining pressure on Iran or applying maximum pressure on Iran. So all of that then leads to a compression in Brent Dubai, while TI Brent tends to widen. So very interesting dynamic, very interesting take on what it means. Now we're going to turn over to products, and I think we're going at it again from a supply side angle with Martha, looking at U.S. gasoline. And so, Martha, what are your takeaways from the implications that we talked in previous episodes, today's elements that I try to put together as a scene setter? What are we focused on in terms of U.S. gasoline then?
So today's trade discussion does revolve around an environmental factor that you mentioned in the introduction, and as you just said, it is a supply side orientated trade, and so I suggested selling the DEC RBOB spread. So that's actually the December 25, December 26 RBOB spread. And that's for the following reasons. The main being, as you mentioned in the introduction, the small refinery exemptions, and also some external factors from the rest of the world, which will obviously come into play in terms of the supply of gasoline into the US. So on the top of President-elect Trump's agenda is the objective to make gasoline cheaper again for Americans. He mentioned it a lot in the campaign trail, and I think this will be something that he will want to be able to point to. It's a number that he can say people are happy because gas is cheap, inflation, etc. The current national average retail price for gasoline in the US across the whole country is just over $3 a gallon. And when Trump left the office, the price was well under $2.50. Of course, there are lots of factors contributing to this, but this is one of his main goals. And so how is he going to do that? One of the ways in which he's going to do that and also represent his environmental views is to change the renewable fuel standard, or the RFS, that is currently one of the environmental kind of constraints, that's the word, in the US. Thank you very much. So his approach to the renewable fuel standard, or RFS, I'll probably say for the rest of the time, will probably have pretty significant impacts, especially if he moves to increase the small refinery exemptions, SREs. So he's increasing the amount of exemptions that they're able to give, and he did this previously in his last term as well. Under these exemptions, small refineries are able to bypass the annual renewable volume obligations, RVOs, by basically explaining that they aren't able to pay them financially. They're demonstrating that compliance to these would cause substantial economic hardship. And this would mean that as these exemptions increase, it will reduce the demand for renewable identification numbers, RINs, as you mentioned in the introduction, the credits the refineries. So look, there's lots of times they're buying these if they're not using bioproduced ethanol, especially corn-based ethanol, D6 RINs. So with less demands for RINs, their prices will fall, supply and demand there. And so therefore there should be a lower blending cost for refineries that do still have to buy them, because this of course isn't a complete removal of the whole system. This is just an exemption system. And therefore, as blending costs decrease, we expect RBOB to decrease too.
No, indeed. And so I guess as Trump comes to reconsider the sort of energy transition, environmental policies, this is a first step in granting waivers, right?
Yes.
But it's not the only step in terms of the renewable fuel standard, right? Because there's more to come.
Yeah,
at least we think there's more to come.
Well, we think there is. I think there was the EPA in the States, which is the Environmental Protection Agency, they had postponed setting the RVOs because they obviously adjust them as time goes and there's more bio products being made and there's just the supply and demand balance changes. So they've postponed setting the 2026 RVOs until after the election. Fairly sensible. And now that Trump has won, we can expect the whole RVO mandate to fall. So this could suggest that the possibility that the whole renewable fuel standard can be fundamentally reviewed and significantly weakened in terms of the constraints imposed and therefore the prices of the fuel sold at the pump. This would suggest that the domestic ability to use roadworthy gasoline would be substantially enhanced. So there are many components in the pricing of gasoline, and RINs just being one of them, part of this RVO, but it could be a substantial part of the pricing of gasoline in the next couple of years, and really important. And not only that, but it could be a significant driver of sentiment in the market. When these things change, they're making headlines, and there's something for people to buy and sell about. But outside of that, in the wider world, outside of the US, we've got Dangote refinery in Nigeria, which should hopefully be exporting more gasoline over the year. This was called the E-Bob killer by many people, and it was meant to have kind of been ramping up for a long time now. And it would be interesting to see, there's a lot of question marks as to where the gasoline is going, how much kind of dibs do they have for local exports into the country, or how much is going to end up going to the US, because they're making US grade, RBOB grade gasoline. So that could also weaken the US gasoline as well if it goes to Europe. Just generally more gasoline in the pool that's going to weaken a gasoline importing country like the US likely. And also, as Vincent mentioned, there's going to be likely more WTI Midland in the blending pool across the world, but also in Europe, where there is a lot of gasoline being made for the US. This is a lighter crude in the slate, so we're going to get more gasoline, and therefore there's even more gasoline in the global pool, another driver that could be impacting weaker US gasoline pricing. To conclude, we are expecting greater US gasoline availability domestically, which is likely to be reinforced by more imports, which would help to flatten the RBOB curve, and thus the proposed trade of shorting the December spreads, the DEC 25-26 RBOB spread.
All right, thank you, Martha. Certainly, it is going to be a top of the agenda how Donald Trump is going to move on environmental restrictions, overturn a number of dispositions that Biden has taken, or even longer-term dispositions that had already started under President Obama. But whether it's waivers for smaller refineries in the first instance, whether it's actually reviewing entirely what is the RVO mandate and making that a little bit more easier to achieve, all this basically tells us that U.S. supply availability, at least domestically, is going to be enhanced. That's one thing. And then, of course, on the other hand, we have external factors, and this is basically how much gasoline is going to be dumped into the U.S. And so if Dangote picks up and does decide to deliver to the U.S., you're going to get more competition, of course, with Europe. And I really thought that was also interesting, tying back to Vincent's argument about more U.S. Midland crude making it to Europe. So the European crude slate getting lighter, therefore looking at that incremental gasoline barrel added to the product output, which of course will need to be exported. So net, we have a supply situation that tends to lend itself to curve flattening, and that is certainly an interesting play in terms of U.S. gasoline. Now, for the last of our trades, I'm turning to Mita, and I think we're going to swap it around. We have a demand-side angle on things for Asian naphtha. So what are you proposing?
Yes, thanks, Harry. I'll be speaking about Asian naphtha, as you said. That's financially the mean of Platts Japan MOPJ naphtha. So the trades we consider are demand-driven, as you mentioned, given Donald Trump's planned tariffs on Chinese imports. So Mr. Trump has vowed to impose an additional 60% or more tariffs on all Chinese imports at a time where China's economy has been in the spotlight for all the wrong reasons. So as a first trade, we recommend selling the Q325 MOPJ crack as a view of declining naphtha demand, given the proposed tariffs on China affecting the Asian petrochemical industry. I would recommend selling this closer to Trump being in office, just so that we have a clear understanding of the implementation of these tariffs. Alternatively, we can recommend buying the Q225 versus Q425 MOPJ spread on the view that the prompt tenor may be more supported relative to the remainder of the balance of 2025. Before we look more in depth on these trades, I just want to begin with a few signposts about China's economy. So all roads have been leading to declining economic activity in China. PPI data recently showed further deflation in October. Loan growth has fallen to all-time lows. And now we may see Trump's tariffs hit demand for Chinese exports. These exports to the US, despite declining from 2021 to 2022, still stand at just over $500 billion as of 2023, as per the UN Comtrade database on international trade. This, as a share of exports, comes up to be 15% of China's exports across the world, with materials such as plastics, lubricants, rubber, resins, all being really important contributors to these exports and to this figure. Now let's consider tariffs. A potential blanket tariff could therefore significantly impact China's petrochemical industry, its manufacturing and thus the petrochemical industry. Naphtha, being a feedstock for petrochemical crackers, could thus see demand decline as a result, or at least would have to be significantly cheaper so that these crackers could stay afloat. In my opinion, this is likely to happen somewhere between Q2 to Q3 of next year. And as a result, I have a bearish view of Q325 MOPJ cracks in the event that these tariffs do take place at this significant of a scale. That said, when we trade on cracks, there is the crude component to consider as well. And crude needs to be firm relative to the product for the crack to decline. Like Vincent, I expect some price support for crude in the start of the year, considering I think it's unlikely for OPEC to return those barrels then, and I think that's more likely to happen towards the end of the year. Although to get away with the crude component, I also recommend the alternative trade that I recommend is to buy the Q225 versus Q425 MOPJ spread. This time commenting on the shape of the curve. And I see some scope for price structure to strengthen ahead of the implementation of the tariffs. So in the interim, I think there are two factors that could drive price structure positively. The first being, I think US retailers, in the case that these tariffs are happening and they're as significant as Trump has proposed, US retailers would want to order more from China in the beginning of 2025, which should keep MOPJ relatively supported in Q225 relative to the end of the year. And we currently have an oversupply of aromatics in Asia. exporters may want to offload some component of the supply at the start of the year when there is just a more relaxed tariff situation, and they could opt to increasingly blend it into gasoline alongside naphtha. While this would be bearish gasoline, it would support naphtha as well in the beginning of 2025. So these factors would support, in my opinion, prompt rise relative to the weaker outlook for the balance of 2025. And therefore, I believe there may be short-term opportunity at the start of the year to buy near-dated Asian naphtha versus longer-dated naphtha.
Okay, well, thank you very much. I mean, that's certainly really taking trade to I think the epitome of at least Donald Trump's economic proposals. Hitting China with tariffs, affecting manufacturing, thus affecting petrochemical demand. And so it's difficult from a timing perspective. Again, we don't know if, as I was saying earlier, whether a lot of the tariff talk and during the campaign was posturing. Will he implement it? He will certainly, if he wants to, be able to implement it a lot faster than in his first presidency. I think it took roughly 11 months before tariffs actually came on from the beginning of when Trump was talking about them. So this time around, it'll go really fast, and therefore the weakening impact on Asian naphtha. So we're centering timing around Q2. That seems to be like a relatively reasonable period, either Q2 or Q3, in terms of a weaker crack. All this, of course, is, we've been mentioning OPEC plus. The crude component still has to remain relatively steady, so it was important for Vincent's Brent Dubai trade. It's also important in this particular case when it comes to selling Asian naphtha cracks. I really like the idea of, like, in the interim, scoping opportunities where, if people are really worried about these tariffs, are they not going to front load absolutely everything they can in terms of producing goods and shipping them out early? And then we may have a spurt of demand where Asian naphtha does strengthen. So timing for the first trade, we probably need more clarity. But I think that we could reasonably expect a front loading, and that means essentially people trying to make things and send them over to the U.S. and elsewhere ahead of any tariff imposition. So that could be an interesting opportunity in terms of curve play, as you were mentioning, where we get a little bit more strength at the front relative to the back. So, well, that's a lot of ideas, and of course, with every trade idea, we try to put forward what we think are the biggest drivers. Naturally, there are other considerations that could come and mitigate, the performance perspective of such trades. Timing, as we know in trading, is everything. And while we may have a good idea, if we time it wrongly, well, the trade idea is not a good one. However, to get more details on all of these trades, we're going to be developing them at length with targets, stop losses in our Onyx publication. So please have a look up for the next publication. What are your favorite Trump trades? Would like to know, because we set out a few, but perhaps you disagree and you have better ones. Would like to know what you'd like to trade under a Trump presidency when it comes to oil markets. So please let us know in the comments below. Now, thank you very much, everybody. Don't forget to like and smash that like button. Actually, not just like it, just smash it, and subscribe to our channel. Until the next episode, thank you very much, and thank you guys for joining.
Thank you.
Thank you.